Hey, it's Eric with thefuturemill.com. Let's talk about the looming stock market crash. We did see a dive in the stock market back in March of 2020, but then from there, we've really been on a recovery pattern ever since. Now, in October of 2020, we saw a 5% pullback in the S&P 500, but we have not seen one since. Now, to put that into perspective, the S&P 500 on average drops down 5% 3 times per year, and we have not seen this in 2021. So there's a lot of reason why people should be concerned about the stock market and where it is going from here. So what I want to do is I actually want to look at the charts. I want to talk about the S&P 500 and where it has been. And the reason I want to look at the S&P 500 is because it is oftentimes used as a benchmark or one that people refer to when looking at the stock market, because it is 500 well-established companies that are in the US. So this is oftentimes a solid way to look from a financial perspective at what the US economy is doing by looking at these 500 companies. So we'll take a look at the charts of the S&P 500, where it has been, where it is going. We'll talk about market corrections, how often a market correction happens, what a market correction is, and are we headed for one? And then we'll talk about PE ratios, because this is one of the ways that people look at the stock market and really project if it is overvalued or not. Then from there, I want to talk about what you should be doing with your money, because that's going to be one of the biggest things. No matter what the stock market does, I think you need to know what to do with your money. So let's go ahead and jump in. This chart right here shows you the S&P 500 from 1991 till 2021. So we've got roughly a 20-year snapshot of the S&P 500. Now, if you're looking at this chart, we can see in 2000, we had a bit of a drop. This is where the dot-com bubble happened, and then it goes up, recovers again. In 2007, we had the global market crisis, and the market falls. Then we start in 2009. This is where quantitative easing was introduced by the United States government. The problem with looking at these charts now is that the government has shown that they are willing to intervene in all of these different ways to prevent a recession. So moving forward, if we look all the way up till 2020, yes, we had the pandemic, and yes, there was a textbook answer of a recession, but it was more of that V-shaped recovery as the chart shows. And we have since then recovered and been on a steady trek to the top. So looking at a chart like this, it's easy to study history and say one way, but unfortunately what we are up against right this second is the United States government is willing to do all of these different things to intervene, such as quantitative easing, lowering the Fed fund rate, and also doing bailouts on these large companies. So if they are willing to intervene, it's really hard to predict exactly when the next economic recession will actually happen. So that being said, this is one way that we're going to look at things, and we do know that if just looking at this chart, we have seen some pretty unhealthy growth, so there could be time for a pullback with the stock market. Now, when I say pullback in the stock market, I could be talking about the 5% pullback, which is a little bit of a pullback, which we haven't seen since October of 2020. But realistically, what we really want to look at is the large pullbacks, or what we call corrections in the stock market. This is where the stock market is going to fall 10% or more. Now, if you're looking at this chart, it's actually showing you that the stock market has fallen 10% or more 11 out of the last 20 years. So doing that, though, what you have to realize is the average pullback has been 15%, but then after that, what ends up happening is the year still finishes on average with approximately a 6% gain for the year. So there is some times in the stock market where you're going to see these pullbacks. So just because we see a pullback or a market crash or a market correction, does it mean that the economy as a whole is going to go into the tank and we're going to see another 2008? It could happen, but I don't have that globe to really tell you yes or no. I'm trying to look at a little bit the crystal ball and let you know. But the truth of the matter is that we are going to at some point see these pullbacks, because it has happened and it continues to happen in history. Now let's go ahead and look at the PE ratio, because I think this is going to be one of the leading factors to make your determination on if you think the market is going to crash or not. When it comes to the PE ratio, this is one way that a lot of people look at, are stocks overvalued or undervalued. Now, it's nice to look at the S&P 500 again, because yes, you could have some company stocks that are overvalued, such as Tesla right this second, but then you have other companies who may be undervalued. And what we're looking at is the averages. So if we go ahead and look at this chart, what it's going to show you is the PE ratio. And the way that is calculated is you take the price of the share of a stock. So let's say the stock is $100, and then you're going to divide that by the earnings per share. let's say the earnings per share is $10. So if you divide 100 by 10, you're going to get 10. That's the PE ratio. Looking at this chart, S&P 500 index median PE ratios, it shows you that in 2001 to 2010, your PE ratio average was 22.4. Now, if we go down to 1991 to 2000, it was 22.6, 81 to 90, 12.4, and so on. So what we're looking at with these PE ratios is to make sure that nothing is totally out of whack. Now, if we go over to this chart with the S&P 500, this shows you the PE ratios all the way back to 1928 in a chart instead of just showing you the median or the average. So what we're looking at here is you're seeing the PE ratios drop down and go up and drop down. In 2009, I would just say that they were totally out of whack because of the global market crisis. But in general, we're seeing PE ratios that are quite a bit higher, but nothing too extreme right this second, though it is quite a bit higher than the average. Now, if you go all the way over here to 2002, now the PE ratio was 44.81. So what it's showing is the PE ratios tend to be higher when we're in recovery mode, which we are in recovery mode right now. So is it the PE ratio with the S&P 500 higher right this second because we are in recovery mode? Or is it because we're just completely out of whack altogether and everybody's freaking out?
We should be buying stocks because inflation is high and nobody knows what to do, and we don't even know, but every YouTuber is telling me exactly what to do.
Whew. Yeah, just that alone could stress me out. So what exactly should you do with your money right this second? Because we don't know exactly where the market is going. Nobody knows when the market will crash, and it's quite misleading for everybody that is out there that is saying that is specifically going to crash at this certain date or this certain time, because you should not live in fear and instead you should be investing. So what should you do? Because there's all of this going on right now and there's all of these people talking. Well, I could give you probably the best advice that you are absolutely going to hate, and that is do nothing. If you do nothing with your money that is invested, that's probably the best thing for you, because we really don't know when the market is going to crash or if it could continue to rise for the next 5 years and we could see all of these gains with the market, and you would be missing out on them if you tried to time it and pull out. Now, with that said, you do have to realize too that you should be putting your money in and dollar cost averaging in. That means that you should be putting it in incrementally. So if you're buying every single month, whether the market is up or down, that's a great way to do this so that you're not just dumping $100,000 or $1 million into the market at once, just in case today is a high point and tomorrow it crashes. Instead, you're just buying at different times and you're getting that money in the market, and you're going to buy at highs, you're going to buy at lows, but overall it's going to average out. So that's a good strategy to use. Now, another thing that you should be doing is monitoring your comfort level. If you think that the market crashes and you're going to freak out and pull out all of your money, that's the world's worst thing. What you should be doing is making sure that your portfolio is aligned for your comfort level, or that you have somebody to lean on to talk you through these things and educate you. If you are looking for a financial advisor, we are fiduciaries. Go to thefuturemill.com. You can book a call with us or find one of the subscriptions that work for you. Or if you are doing it on your own, make sure that you have support of people to talk to. Don't just jump on YouTube and try to make a decision, because oftentimes these YouTubers are doing everything for clickbait, kind of like the title of this video. But that's the way to get you to watch this, to make sure that you're getting educated. So those are a few things that you should be doing with your money if the market were to crash. Just remember to stay in there for the long term. If you have any questions, like I said, you can go to the Future Mill. You can book a call with me. But thank you so much for watching.